Today's Friday, September 8th, and we are going to break down the CBOE's new 0DTE report that came out yesterday. And we love the CBOE. We're big fans of theirs. Obviously, the S&P 500 index trades there, which is one of the largest options complexes in the world. And anytime they give us some data, we love to dive in and see what's going on. Now, they have a lot of data that we're not privy to. Obviously, there's a lot that they have available kind of under the hood or behind the curtain, so to speak. And so we wanted to dive in here, give our analysis of the report. We have a couple alternative views we wanted to express here. And with that, we will just dive in. Now, many of you remember that it was only a couple months ago that there was the JP Morgan Volmageddon hype. That was kind of extreme fear. And the CBOE report is kind of a 180 from that, saying that there's very little impact, they think, from the 0DTE options. And we're a little more in the middle. On average, there's not a ton of exposure, or maybe the 0DT is being used for flows, hedging flows, instead of futures or something like that is kind of our view. And so you don't kind of want to like dismiss the 0DT, but you also don't want to be freaking out about the Volmageddon hype. So again, it was only 6 months ago that everyone was focused on this Volmageddon kind of craze of 0DTE. We came out and said no, as well as a few different banks, and basically said, look, if you lock the market limit down, that halt is probably likely to take a bunch of the momentum out of the market. Traders are going to want to close puts. And so maybe you get like a flash crash intraday, but a kind of multi-day episodic Volmageddon type scenario, probably not as likely. Now, let's dive into the actual CBOE report here. We'll provide a link to the CBOE report in the comments section below. But essentially what they do here is they break everything down by gamma. They go, what is the gamma exposure? They explain what gamma exposure is. And they are right here to say that, yes, it's huge S&P 0DT volume. It's about 50% of options exposure. And that volume does not equal risk. It is about balance. And so what they do here is they give us a one-day view. They like this August 15th example, and they say, look, all of the puts that were bought by market makers were also sold by market makers, and so the net exposure is zero. And this is net exposure on the day. What we would want to see here is a little bit more information about this specific trade, because what is likely to happen is that if you buy a bunch of calls on the open for 0DT, you'll probably sell them at the end of the day, right? So that is going to mean that the 0DT volume could indeed be a lot of positions being open and a lot of positions being closed, but there's exposure intraday on those positions, right? And the second thing is this is just net market maker positions. Obviously, there's a whole bunch of market makers. There's a couple that are very large, and there's a few that are smaller. And so is it all of the biggest options market maker in the world buying these puts in the open, let's say, or at the start of the day? And then is it a couple of the smaller ones selling them at the end of the day? You know, you can't, if you're going to talk about balance, you also need to understand there's obviously a lot of entities transacting here. And so what we really want to know here is, what is actually happening intraday? There's got to be pockets or areas of exposure, if not for the market as a whole, but then for a given market maker. The second thing that they highlight here is that they do have a lot of data that a lot of us aren't privy to. For example, the customer type, market maker, broker dealer, etc., whether option was bought or sold, open or closed, all these kinds of things. And so we would have loved it if they kind of like broke down the flow a little bit further for us, right? What is the market maker exposure throughout the day? When are the options bought to open versus sold to cover? That kind of thing that would have been a little bit more helpful in this report. So our theory here to this point is that the 0DTs are a substitution maybe for futures or other type of hedging flows. And the reason we say that is because we'll get down to this at the end of the report a little bit, is that volatility has not obviously switched or changed over time. And we're going to, again, discuss this as part of the CBOE report. Further, if we look at a lot of our models, our volatility estimate, for example, still hold true today, even though the 0DT phenomenon has really picked up over the last 6 months. So that those types of things suggest that there is a substitution effect here as opposed to a new flow that is coming into the market. Okay, their key sort of point here is that look at the gamma exposure throughout the day. And you can see here they flagged this a bunch of times that the median exposure is something like $200 to $600 million. But as you can see here, there are some pretty big ranges as they break it down throughout the day. So the gamma of the market makers, as they stated here, is typically fairly small, just a couple $100 million, but it can really expand, as you can see here, to a couple $1 billion, which would be pretty large. And depending on the day you're trading, that could be obviously pretty impactful. So again, on average, doesn't mean a whole lot, but there are these times when this stuff matters. And this is just how you look at it through a gamma lens. And we suspect, or we would interject here, that gamma on a 0DTE option may not be where a lot of the bigger flows from 0DTE are hitting. So let's break down why you want to consider deltas when you're looking at 0DTE. So with the S&P at 4460, somebody comes out and they buy 4460 0DTE calls. Those have a delta of just about 50 and a pretty small gamma there, right? So great, the market maker sells the customer the call, and then they buy 54 deltas per contract to basically hedge themselves. And if the stock market goes up, if the S&P goes up, they got to hedge. They have to adjust their deltas, and they continue to do that by buying stock or futures as an example. Now, of course, there's a market maker book, etc., but we're just trying to break down a very simplified example. Now, at 315, the market, let's say, has rallied to 44.90. That's now a deep in the money call. So the delta of that position is, let's say, 95. So there's a much bigger hedge that the market maker has on for this position. And the gamma of this position is probably next to nothing because it's so late in the day and the option's pretty far in the money. And so the market makers short that call, but they have a huge delta position, so there's not really much gamma. And if the market does nothing, they are happy for the rest of the day. Now, what happens at 3:30 if the customer goes, great, I'm deep in the money on this call. There's no point in me holding it for another half an hour. Let me just cash this thing out. Well, all of a sudden, the dealer no longer has that call position, but they have these deltas. They have these deltas that need to be unwound, right? They got to sell that position. And this is oftentimes why we'll see big, heavy options flows in the day, either bullish or bearish options flows, and then towards the close, those positions will switch and we'll get a lot of mean reversion in the market. We've documented a lot of these instances on Twitter or X, as well as on our website, SpotGamma.com. So we know that these delta flows are impactful. There's an example of this coming shortly. Now, that is why the deltas matter. Now, if you go back to their report, they talk about the fact that the gamma exposure is 170 to 600 million throughout the day, and that's admittedly not a lot based on this metric. And then they further say that the S&P futures, trade 400 billion a day, and so 100 million, 200 million is like 10 basis points worth of futures liquidity. Now, the issue is that if you suddenly have a lot of gamma thrust upon you and you need to hedge that, you're probably not going to hedge that in some VWAP style over the day, right? You're going to be a little bit more active with how you trade that. So if you suddenly have $2 or $3 billion worth of gamma exposure and you decide you need to hedge that, you can imagine that if you have to execute, say, 2% of daily futures volume in 10 minutes, you're probably going to move the market, right? You're probably going to boost or impact things. So again, just as you don't want to overhype the Volmageddon scenario, you don't want to sort of make it de minimis and saying, look, it's only $170 million of gamma exposure. What's the big deal? On the average case, that's probably true, but there are days, obviously, where that exposure changes quite a bit. The other thing they rightfully note here at the bottom is that market makers also have spider 0DT options, E-mini futures options, E-mini positions, spider positions, QQQ options. There's a lot of other things going on here in the book, but they do kind of give this nod that market makers could actually be using these 0DT options to hedge as well, which I think is kind of a key footnote and syncs with one of the reasons or one of the ways we think that 0DT is being heavily utilized. Now, our analysis has concluded the same thing that they show in this report, in that there's not a discernible change in intraday volatility. And at the end of the day, this is the point that the CBOE is trying to make, is like, look, if 0DTE was blowing the market up, it would show up in volatility, and it's just not showing. We're not seeing unusually depressed volatility, you could argue, from this chart, which shows you the close-to-close volatility of the S&P 500. If you look at it on a daily basis, it's kind of a similar thing. This shows 1 month close-to-close volatility. There's not a obvious fingerprint to this flow, which is another reason why we think that 0DT is being used as a hedging substitute, as opposed to, for futures or something like that, as opposed to some type of new flow. One of the more interesting aspects here is that they uniquely flag this day, which was August 15th. And this day made headlines in the options space because a Goldman analyst pointed out that there was a very big options trade that took place. And that was flagged by Goldman as being the reason that the market moved, and that kind of stirred up this Volmageddon, or 0DTs really moving things and causing havoc in the market. BofA said no, and, we kind of bounced around. But the key point here is that there was big flows and it made a lot of noise. And CBOE isolates this specific day. And what their argument here is that this is where the trade took place, right in this area. Their argument here is that if you look at what happened, they estimate that market makers were long gamma in that position. And if you're long gamma in that position, then you should be buying as the market declines and selling as the market rallies. But what's interesting here to us, and if we flip to this chart, you can see it maybe a little bit better, is that throughout the day, if you kind of exclude the opening move down, throughout the day, the market really did not do anything. It pinned at 44.50. And based on CBOE's own gamma analysis, gamma did not change much throughout the day. And it's not clear exactly how they're measuring gamma here. They don't really break that down on the paper. But from their interpretation here, there's not much gamma throughout the day, and the market doesn't really do anything. And then for whatever reason, most likely we think volume being added, because this is when Goldman flagged this trade, you can see the gamma exposure suddenly increases. Now CBOE says this is positive gamma exposure, so that shouldn't induce volatility in the market. But regardless, you suddenly see this very large spike in gamma based on the CBOE's metric, and then the stock market or the S&P immediately drops, right? And this isn't a full-on crash, it's a 15-20 handle decline, but we think it's really interesting here that while CBOE says, look, this is positive gamma exposure, shouldn't have done anything, it's exactly when this trade takes place that the market falls down, and there's this big exposure on the day that makes the market decline. So, was one of the market makers suddenly saddled with heavy negative gamma exposure? Was there a dealer that was saddled with negative gamma exposure and they hedged, and the resulting trade was a market maker was positive gamma exposure, but a dealer had negative exposure, right? There's this tangled web that you'd have to kind of unwind. But the key point here is that this gamma is induced here by 0DTE exposure, and the market reacts to that. Now, if you break this trade down by deltas, you can see the fingerprints of this trade rather precisely. Now, this is from our morning note on Thursday, August 17th. We talk about the trade. You can see here, again, Goldman flagged this rather large trade of 99,000 puts with a pretty big notional assigned to it, and it traded right at 318. Now, our HIRO indicator, which is what you see charted here, measures options deltas in real time. And teal is the 0DTE deltas for this day. And what you can see is exactly at this time that Goldman flags wherein this big trade took place, you can see the deltas drop, right? And what this tells us is that somebody started buying puts or selling calls, and the deltas decline. And it is right at that time that the market starts to drop rather precipitously. And again, this is right at 318, which corresponds with when this gamma exposure that they highlight increases. So exposure changed. They see it as long gamma. We see it as short deltas. And with that, the market drops, again, rather sharply. So when you look at the delta exposure getting hit, and remember, delta is largest for at-the-money options or in-the-money options, as we explained in our example before. If those deltas are really changing, then that means that the exposure is changing and it has to be hedged. Now, that can mean, again, with the 0DT option with only an hour to expiration, the gamma could be pretty small. But if it's in the money option getting traded or an at the money option getting traded, you get a pretty big deltas associated with that, and that could really move the market. So that is why we think that what we'd love to see from the CBOE is a little bit of this delta analysis. If they could break down when positions are getting open and closed, we think it would be very helpful to explain a little bit more about what the impact of these options and trades are. Now, that is it for us. We hope that you found this breakdown helpful. If you have any questions, please shoot us a note at info@spotgamma.com. You can leave any questions in the comments section. And if you're interested in getting our daily analysis or access to the HIRO, you can just hit subscribe now and check out a free 7-day trial.